This is RegCast, your edge on RegTech, risk, and regulatory transformation. Hosted by RegTech pioneer PJ Di Giammarino, RegCast delivers regulatory clarity, AI precision, and market trust with expert insights from the front lines. From MiFID III to AI, we connect regulation to execution, charting the path to credible compliance before gaps become capital or reputational risks. Subscribe on Apple, Spotify, YouTube, or at RegRiskLegalSolutions.com and stay ahead of the regulatory curve. PJ Di Giammarino is one of the original architects of RegTech. With a career spanning Barclays, McKinsey, and his pioneering work at JWG Group, PJ has spent the last 20 years helping regulators and financial institutions decode complexity and transform compliance into competitive advantage. Now, as CEO of RegRisk Legal Solutions, he's at the forefront of AI-enabled regulatory intelligence.
Hi, welcome back to RegCast. In episode 3, we looked at the hard truths underpinning reporting architectures and why machine-readable compliance really matters now. In this episode, we're stepping back a bit. We're going to widen the lens to include the point of trade. And because the real question for 2026 isn't only how you report, it's whether the buy-side trading desk can stay profitable while meeting lots of new expectations. And so this really matters now because margins are under siege. Execution management systems and data costs are exploding. Broker subsidies are collapsing. And supervisors are embedding technology and data risks directly into their capital calculations with Pillar 2. And at the same time, clients are demanding more transparency and proof of how AI strategies really improve not only execution, but all aspects of a buy-side's value proposition to its clients. So a lot of these subjects aren't new. They have been kicked about for a while, but I believe we really are at a tipping point with the buy-side. And technology can no longer really be treated as plumbing. It's now been forced into the boardroom by the AI conversation. So the 2025 budget cycle is really going to lay some critical discussions on the table for senior management. And those that move forward and really embrace this moment are going to adapt, and those who don't are going to carry an awful lot of legacy debt that's going to fall into a 2026 capital trap. So to explore this shift, I'm joined by Rebecca Healey. Now, Rebecca, I've known for a couple decades in a variety of different guises. I know her right now as the chair of the Fixed Trading Community AI Working Group and the author of a Kraken report that we're going to put into the link to the podcast episode, of course, is Connectivity in the Age of AI. So Rebecca's work lays bare the economic fragility of the current trading infrastructure and the urgent need for AI-ready standards and governance. Rebecca, welcome. I've known you in a variety of guises over the MiFID campaigns and ISO TC68, where we're both members. But please tell folks a bit about your professional journey to get to this point.
Well, thanks very much for inviting me on, PJ, first and foremost. I think it's a super interesting topic right now. The reason I think it is, in terms of where it sits with my journey, I was fortunate enough to be at the start of electronic trading under Rich Valarkis' team of AES back in the day. So we're talking late 90s, early 2000s. And I think where we're at now, it's an interesting juncture because it's almost like we're playing back a lot of the innovation that happened that time around, but under a different guise. So where I think connectivity previously was very much all about how do I get from A to B the quickest way possible with the best algo possible, what you're now seeing is connectivity extrapolated out to include the whole front to back life cycle, which is where that sort of, you've got the melting pot of AI, connectivity, technology, infrastructure, data, that's all playing into a conversation the buy side is now starting to have about what will connectivity in the age of AI mean for me? I mean, you mentioned the report, and I think it was a super interesting research project to undergo, just in terms of actually the questions that are now being asked. And if I take it back a couple of years when we started looking at AI in trading, That was very much sort of like heads of dealing talking to me saying, you know, the boards come downstairs and are saying, we've got to do something with AI, but what? What does that actually mean? Because nobody really understood what AI was. And I think if we stop thinking about it as AI in terms of ChatGPT and OpenAI and Claude and all the rest of it, and see it more as the next stage of automation within the sort of the execution and investment process, that's when all of a sudden the conversation starts to get really interesting, because the setup that we've had thus far in terms of connectivity has really focused on the EMS. And the EMS was born out of the fact that actually sell-side global brokers didn't want to keep investing in their own single dealer platforms. So they needed to embrace the execution management systems. And as you pointed out in your introduction, that economic model is breaking down. And the reason I say that is because the execution management systems are almost a victim of their own success, in that they've become so integral to the execution process on the equity side. People want the same level of execution sophistication in other asset classes. So they're looking for that data and that information to be front and center when they trade. But the problem is that actually that costs money. Yeah. And there has been there's been an ecosystem that's operated well in terms of under MiFID II, the buy side were able to continue paying for their EMS systems because the sell side was paying for the connectivity, which was agreed under MiFID II rules as their means to still connect to the market. Now you start moving that out across other asset classes, and that payment model doesn't function in the same way, number one. Number two, it's getting a lot more expensive. So when before it was sort of like, I don't know, sort of almost like an industry norm was $500 per terminal per user, that is actually getting far higher, and you've got commissions coming down. So all of a sudden you've got a scenario where the current status quo is no longer fit for purpose. But where I think is more interesting is we're looking at, okay, what do we need? You know, what does that mean in terms of connectivity? Because it isn't going to be an automatic switch from the current status quo that the sell side pays that moves to the buy side. I think the buy side is starting to ask questions that if I've got to pay for this tech stack, what do I want? What do I need? How does it function?
Well, and I guess that's a great point maybe then to start from the client pressure point of view, because ultimately that tech stack that the sell side has invested trillions in over the past 20 years is now having to be picked up in a much more nimble and agile way with clients that have different expectations. So from your point of view, what are some of these client pressures that the buy side are facing, and how can the technology help?
Well, I think first and foremost, where firms are at in terms of the report is actually trying to understand what the costs are. And that's also interesting in terms of AI. So I was talking to a firm last week, and they've actually invested in AI in order to be able to manage their connectivity costs and actually understand the front to back cost. Yeah. And again, this is what I mean about it's the next stage of innovation that we're seeing in terms of the automation journey. Because if you go back to the early days, you know, understanding what your actual exchange costs was very difficult. What we're now looking at is what does it cost me to execute an investment idea? Now, we can argue that some of the tech savvy hedge funds, you know, they've invested millions, billions, whatever in this, and they've had a very good handle on what their actual costs are. But this is moving more mainstream. And once you start having the cost of what does it cost me to make an investment decision? You know, what does it cost me to execute on that idea? Then it starts bringing in modeling and looking at, okay, what are the alternatives? What could I do here? And this is where we're starting to see interesting challenges to the status quo. So I think if we look at sort of financial services vendor technology, it's been dominated by a number of key players in the industry. And now what we're starting to see is the challenges in that particular area. So things like, for example, you have a BT Radiance line, or you have, your standard fixed connectivity telco. But does it have to be that, or could it be something different? And we're starting to see challenges, firms like AWS, Microsoft Azure, who are coming in and say, actually, we can do something different. We can do a private wire. So all of a sudden, what was off the table is starting to come on the table, and really buy-side firms are able to look at this in terms of, what would I like to construct as my tech stack going forward? Where do I get value for money? And do I look at alternative providers rather than just the status quo? So, I mean, classic case would be, there are a number of financial services incumbent vendors, and it would be automatically you would look at their offering. Well, now, is that the case? And that also ties in with sort of a lot of the DeFi moves, and people really starting to question, do we do what we do? Why do we do what we do? And is there an alternative?
And I guess that a lot of that what you're saying speaks to me about the analytics and actually getting to some of this granularity and the detail of how things work today and how much do they cost. How much of that is being driven by the client discussion for the buy side? So the actual asset owners, are they the ones that are demanding to understand these changes in a bit more detail?
Well, I think if you speak to any asset manager, the conversation around data and analytics is becoming much more prevalent, particularly when they're talking to the underlying investors. Whereas before, I think sort of best execution was very much how you chose to demonstrate where you deliver best execution. Now it's becoming much more of actually, I'd like to see the evidence. And I want to see how you're using data and analytics, and how does that actually play in. And it's interesting, because I think more as AI gets involved in the retail space, people are becoming aware of what is feasible that perhaps wasn't feasible historically, because it was very much of a closed shop, and sort of the institutional vendor engagement was with the traditional incumbents. So if you look at some of the developments that you've seen in the Robinhood space, or Perplexity, or any, you using ChatGPT, it's really beginning to challenge what we see as possible within the realms of using data and analytics going forward. And I go back to sort of like some of the hedge funds that have done this probably for the last 20 years. But it's more around how that is sort of seeping into general discussions about what's possible, what's available, and challenging the price points. Because I think, we've already started to see some of the conversations that are going on LinkedIn around people building models for a fraction of the price that was available before. Now, I'm not saying that we're all going to move to zero cost anytime soon, but it is an interesting indication of the alternatives that are emerging within the space. Now, I know that security is an issue. And also, realistically, you're going to rip out a technology infrastructure solution and just go for a new fintech company when you haven't got sort of like the decades-long assurance that actually this company will still be around. They know what they're doing. We don't have the NASDAQ OMX outage only recently. So it's always front and center of people's minds just how resilient a particular company is.
Yeah, but if you liken it to the post-trade space, which our listeners have heard a lot about, there's a certain gestation period where people then begin to look at open sourcing and creating common libraries and models where people can not have such expensive IP locked up, and that you can ultimately be shared assets, things like using the common domain model as an example. Do you see any of that happening in the especially in the digital asset space?
Well, I think this again has been quite interesting just in terms of the discussions that I had with people for the paper. So obviously, FIX is front and center for the institutional workplace infrastructure. And it has been for the last 30 years. I think it will continue to do so. But that doesn't mean to say that there won't be developments within the open protocol space, FDC3 being one of them. There's another development that's happening, as you mentioned. I'm co-chair on the Fix AI working group. And one of the areas that we're now looking at is sort of agent-to-agent workflows and how would that actually play out in practice. And this started sort of back in June last year, actually, just in terms of people choosing to look at building AI models and what would they need for the models to work well and accurately, because it's one thing to invest in an AI, it's another thing to make sure that the AI is actually doing what it says it needs to be doing and doing it accurately. And this is exactly where the open standards and sort of ensuring that there is almost a level of mandating, whether it's self-mandated or regulatory mandated, where people are using fixed messaging in the way that it needs to be done. Otherwise, the information that you're receiving is pretty much useless, because you're then going to have to interpret it in another different way. Now, there are those that say, well, you don't need fixed protocol for that. My AI agent will rewrite it. But that's just layering on another level of unnecessary costs. So I think you're right. Actually, the more that the industry moves forward with introducing AI into the front to back work life cycle, the more that we will need these protocols, and the more that actually it will be incumbent on everybody in the industry to use these in the way that they're meant to be used.
I think that's a great point, which is that the message is just a message. And why would you want to reformat a message? What you want to do is build the intelligence around the message and the models tied to it, so that you can help understand better the context of what's going on. And I guess that's in part, I think, the regulators' catalyst here as well. If you look at DORA, and you look at the EU AI Act, separate, apart from the MiFID conversations about trading and what you're trying to achieve with liquidity, they're looking for control. They're looking to understand when that transaction was done, what were the controls in place and the procedures and the validation around the trade. And ultimately, that's where they've gone with their supervisory enforcement program with the ECB. Then that's what the SREP is what they call it, and they can now use that to assess infrastructure surcharge, essentially. A tax on your digital integrity called Pillar 2. And ultimately, you look at all the Dear CEO letters and all the noise this summer in that space, and it was really quite heavy. I mean, people they're really demanding proof for all this. So what do these shifts mean for firms that are hesitating on these technology investments, and where do you see regulation as a catalyst?
I think it's a very interesting point that you've just made, because it is much more around what's your internal capabilities like, and it goes back to the old adage: you can outsource the technology, you can outsource the infrastructure, but you can't outsource your actual regulatory obligations. And so that level of oversight is an interesting dynamic, because I think what we're starting to see is firms looking at, okay, so if I work with a third-party vendor, how do I work with them? What's the level of oversight that I have over what they are actually doing? So that, again, it's a different conversation, in that you're not sort of like bringing in a third party and that's the job that you do. It's like, how do you engage with them, and what's your framework around your governance processes, your actual AI implementation? How are you building your models to make sure that you've got that data integrity? So it's a completely different conversation in terms of the setup that you could potentially want. Then I think again, it goes back to the conversation about who do I actually partner with. And it's interesting, you spoke to people, I don't know, even a couple of years ago, would they have been talking about Snowflake, Databricks, Dataminr, all those. We've got different companies that are forming part of the conversation in terms of who are the right partners. And again, I go back to AWS and Azure. It's a different conversation that people are having. So I think from a regulatory perspective, the one thing that struck me is, again, it's much more about understanding if you are going to use these tools and technologies and go down this particular path, what level of assurance do we have that you're actually putting the appropriate governance and management around that process and keeping the integrity? So it's less about prescriptive top-down, sort of follow this particular rule, and more about can you actually stand behind your process, and can you demonstrate that that is actually going to meet the level of integrity that you need to have in order to participate within markets?
And it's not like that's a future thing either. I mean, these are obligations that went in this year. So DORA and the UK equivalent are effectively laws of the land as of 2025. We all know the audit cycle and the people coming in to look at how well you've done, which are actually mandated within DORA. There will be these things being surfaced to the boards at the end of the year that should feed into their 2026 assessments about what their priorities are. But my question, I guess, to you is about timing. From your discussions, you sense people are looking at this budget cycle as just one like any other, or is there actually a bit of fear there that says, no, we need to move now, otherwise we'll get penalized?
Well, obviously, fines have been an area that is ramping up gradually in terms of people understanding what their obligations are. So that aside, obviously, has had people's attention. But I think it's different with AI, because if you go back again, so say like last year, there was a lot of sort of noise and hype around AI. And this is what I mean about moving AI away from the silver bullet to more of, actually, it is the next stage in automation. So what does that mean that we can actually do? And that is where I think it's starting to become more interesting in terms of understanding the automation of the investment process. And what data and analytics do I need to feed into that to be able to run more effective models, and that the AI can support? And that, I think, is what I mean about the next level of machine learning, deep learning, rather than seeing AI as sort of this completely autonomous agent that runs off and runs your trading desk for you. It's a much more, without meaning to sound fickle, it's more of a grown-up conversation about what the reality, the limitations of AI, as opposed to assuming that AI is going to take over a trading desk. That isn't going to happen anytime soon, in exactly the same way that algos didn't take over traders. There's going to be different roles, different jobs, different applications. But that, I think, is the level of investment. And this is what I mean about the conversations with the likes of Snowflake. What data do I have within my organization that I can use in a much more efficient manner? Where do I need to partner with other third-party vendors? And how does that work within my existing system? So again, going back to sort of the conversations in the beginning about sort of the EMS and the OMS and what's the most effective use of the systems that are available to me today. Another firm that I was speaking to last week, they were saying, actually, for fixed income, do I need an EMS? Or do I just need a better OMS? Or do I need an OMS that's prepared to partner with a fintech third-party vendor that can actually give me access to the information I need when I need it, and port that data to where it needs to go within my organization, rather than ripping out and replacing what I've already got? Yeah. So it's a very different conversation now about people beginning to appreciate what the next stage of automation will mean, and then how do they get the best access to that within the third-party providers that they have today, and where do they need to add to get the differentiation?
Yeah. So I guess the question I was asking was about timing and urgency for change for the 2026 budget cycle, the investments being made next year. The sense I'm getting from you is that these strategic conversations are happening, but I'm not really sure whether that means committing to new pathways next year. Do you see that happening?
No, there are conversations going on at the moment where people are looking at where do they need to make the investment, and who should they partner with.
Right.
So those conversations are definitely happening right now.
Okay, so a lot of the legacy vendors then are probably like in the reporting space. They're beginning to feel a bit nervous and beginning to understand, okay, well, where is it, that there is a change happening. What do you think this means from a vendor perspective?
Well, I think it's like any legacy vendor provider. If you're not staying front and center of where the developments are, that's going to be problematic. But I think any vendor worth their salt is obviously clearly looking at this already. And we had an interesting discussion actually at Bix Nordics where there was a large third-party vendor on the AI panel with us. And, then he made the statement that they're very aware they can't do everything themselves now, that the speed of innovation that's taking place outside of the industry means that actually they have to embrace and work with third-party vendors at a far greater level. Because if we think about it, we've taken a bit of a back seat in terms of the innovation within the financial services industry space, because it has been very much focused on getting to market as soon as possible. Any innovation has been very much MiFID II focused and making sure that I meet my compliance obligations, not necessarily experimenting with where the technology is now at and how that potentially could be used in a workflow process. So again, I go back to the fact that it's a different conversation now because of AI. AI has almost been the Trojan horse that's sort of pushed through.
Yeah.
And so now you can have a different conversation because so long as it's, and it's like somebody was saying to me, if it's a budget request and it's got AI in it, I'm guaranteed to get sign off. If I ask for anything else, I'm not going to get anything at all. Yeah. So there's an AI momentum that I think firms are actually using cleverly to make sure that they get the level of innovation that they want. But it might be in something like Snowflake, which, because it's got the AI tag, gets through.
Yeah, understood. And I guess that speaks to the other Trojan horse here, which is the economics, in that the structurally things need to change. I guess, do you see the subsidy model as well and truly dead? And is there now a whole new move to find different economics?
Look, the reality is there are a lot of people who would say that there isn't a subsidy model, and they're very clear that they choose to pay for their execution management system completely independently because they've taken that view. So I don't want to sort of cast everybody in the same bucket, but I think there's a broader conversation on what does it actually mean for how people connect to the market. And that's obviously something that the European Commission were looking at. But I think it's a more basic conversation about what does it actually cost. And while there was a lot of money swirling around in the system, I think people were just willing to sign off on invoices. And there wasn't that forensic lens that actually the industry needed to have about what does it actually cost. Now, as we've seen equity commissions come down, and there's been an important shift from a sort of a minimum fee that's moving more towards the transactional cost, which, EMS vendors would defend, saying that there is a minimum level. So, you'd hit a threshold and then you'd only pay the threshold fee and not for anything in over and above that. Now, if you're a top 3 broker, that's great. But if you're broker 15, 20, that's a problem because you're paying per transaction. You're not seeing an awful lot of the flow. And this is where I think there's going to be an interesting shift in dynamics about how do tier 2s respond. And so what I mean here is because the old economic model is broken, I don't think we're necessarily sure what the next economic model will be. There's a lot of chatter about producing EMS Lite and looking at sort of cheaper options. Maybe it will be things like OMS Lite, where they work with third-party vendors to try and enable the connectivity at a lower price point. But I'm wondering whether we go next level on, just in terms of actually, will connectivity be free going forward? Because I think we're at that point of again, I go back to, there's sort of been a standard fee of $500 per user per market to trade. Where did that level come from? Why we just sort of automatically accepted that's what the cost is? If you think about sort of like the difference in mobile phones versus a standard fee. And I think that was one of the discussions that I had in the paper of people saying, does there need to be a complete rethink about what does it actually cost me to connect to the market, and why is it at that particular price point? And where's the value? And is the value not in necessarily connecting quickly to the market? Maybe I can connect slower. Do I need to have speed if I'm trading in a different manner? And what I mean by that is we're starting to see in the equity space, there's a lot more sort of bilateral pools of liquidity rather than necessarily everybody trading on a central limit order book. So the whole point was you needed to connect to the market and you needed to make sure that you were as fast as possible so you didn't get run over by HFT. If you're gravitating to a separate pool, that's a different ask of what you actually need from your connectivity. So the old economic model is breaking down. But I think because we're in such a state of flux of where the market's going, not least of which when you start looking at what the ask is for fixed income products, the future connectivity may be very different.
Right.
And so I think so now it's much more about, do I have the right infrastructure in place? That means that I can get everywhere that I want to get to. Do I have robust and reliable systems? Do I have the ability to port my data? This is where you started off by talking about plumbing. I think people are looking at their plumbing in a different light now of just making sure it is robust enough, not least of which from the transaction reporting element. But I think it's also more around actually the way that I trade is going to be different.
Yeah.
So for that.
So Rebecca, just in wrapping up, if you had one message for buy-side leaders generically, I mean, obviously, you to take your point that there's the different flavors of them, but in terms of setting their budgets in Q4 this year, what would it be?
Well, I think it's really understanding, what do you need? So it's sort of understanding any systemic fragility within your system. So making sure that it's that whole front to back forensic look at how do my systems actually work. And it's a shift away from looking at it in isolation. So rather than looking at front office and back office, equities, FX, fixed income, I think it's more the holistic overview that's going to be much more important. And then it's mapping sort of the different elements. So whether it is the data versus the technology infrastructure and the portability, again, it's the front to back, the testing and the ability to evidence what you're actually able to do. So I think there's the roadmap discussions are happening now, and then that's when the engagement will start, followed by the actual implementation next year.
Yeah. Okay. This is definitely a space I'm sure we will be coming back to, but thank you very much for all your insights today. And we will put a link to the report in the description of the show notes. From my point of view, what we've been talking about today is that AI isn't just another tool. It becomes a whole new lens by which the future of the buy side, is going to be judged. And clients want to see it in action. Regulators want proof, and the economics, are shifting. So if you have a lot of legacy debt going into that environment next year, it's now a capital trap, and it's also a competitive disadvantage in the market. So firms that continue to patch things and just wait till they face the penalties and then they'll move are going to really suffer. But those who find AI-ready standards and start working this next year to figure out how they flip the compliance threat into a savings and actual advantage, they're going to be the real winners. And that's exactly why we've just launched the RegTech Edge, because I think the buy side discussion around how they deploy RegTech is been lagging where it's been on the sell side. Everyone gets the same free emails and alerts from consultants and vendors, but to really understand and go beyond the headlines, we've now positioned our newsletter firmly in the analysis space to work out what's happened, what matters, and what decisions do you need to make now. A lot of these weaknesses will result in real fines. A 0.5% capital surcharge will wipe out 10 to 15% of return on equity, and it's going to linger for years. So you can't really mess around starting next year. You need RegRisk control, and ultimately our radar, which we've just published, distills the 25,000 pages of analysis we had to do just in 2 months during the summer. Just to be able to put all these regulatory obligations into the hot zones and help people get the foresight, clarity, and evidence that they're actually looking at these things when the regulators come knocking next year. So with the Q4 budget window closing soon, encourage everybody to join the conversation, listen to RegCast, and subscribe for RegTech Edge, and move forward to a much better place for 2026 where your reg risks are under control. So thanks very much, Rebecca, for participating.
Thanks for having me.
All right. Cheers.
You've been listening to RegCast, delivering regulatory clarity, AI precision, and market trust. Please subscribe and share. It helps more people join this vital conversation. Find all episodes on Apple, Spotify, or at regrissolutions.com.